So Hayley, what is PMI?
Everyone asks what PMI is. PMI is private mortgage insurance. PMI honestly is not something that you want unless you need it. If you have a 20% down payment, you could avoid PMI. So what PMI basically does is you are essentially buying a policy that is part of your monthly payment that insures your servicer in case you default on your loan, they get paid back. So obviously you can tell from that explanation, there's not really a benefit to you. So if you don't have to have it, that's great. If you've got 20% down, phenomenal. If you don't, what's nice is PMI actually is pretty affordable. Everyone thinks it's hundreds of dollars a month. It's not. Depending on your down payment and depending on your credit score and your loan type, where if you're a first-time home buyer or not, basically, that PMI can vary. So when we're running those numbers for you with your closing costs as well, we also will do a full payment for you, and that will tell you kind of a breakdown of what you can expect for your principal and interest, your taxes, your homeowner's insurance, and your mortgage insurance.
Yep. Is there any way to, besides putting 20% down, is there ways to avoid the PMI and the payment?
Yeah. Well, let's say you're a veteran, perhaps. Veterans do not have any upfront mortgage insurance or monthly mortgage insurance, which is really great.
Yep.
With conventional financing, if you do happen to have PMI, that's completely fine. You are able to get rid of that once you pay your loan down to 20% loan to value. A lot of times, if you're a first-time home buyer, you'll start a conventional loan with either 3% or 5% down. So you either can naturally pay that down as you make your monthly payments, or you can choose to make extra payments on your principal to reduce that quicker.
Yep. And another really cool option with the conventional purchases is you can do actually like a one-time PMI private mortgage insurance buyout. So if you've got really great credit and you're putting, let's say, 10% down, you can pay a one-time fee to actually pay that off at closing and not have it included in your monthly payment. Absolutely. So sometimes people have a little bit of extra cash on hand and they want to get that payment nice and low, and that's just a good way to do it. Yep. So that's something we're always looking at. We're looking at all of the different options out there to make sure we are finding the best, fit for you.
Yep. And let's say too that you own a house currently and you've got a lot of equity tied up in that house, but you really want to buy another one so you're not having to move twice. You want to buy the other house first and then sell your current house. That is possible, and the reason I'm bringing that up is because let's say you make money off the sale of your house and you want to apply that towards your mortgage. You can do that as a one-time lump sum and do what's called a recast to not only get rid of your PMI, but you can also re-amortize your payments to reduce that payment based on your new loan amount.
Yep. And that kind of ties back into the competitive market. It's if you are able to afford both mortgages for maybe a short period of time, it makes your offer for the purchase side nice and clean because it's not going to be contingent on you selling your current house first. So, so that's another just great way to do it.
Yep.